Hi everyone, in this course we are going to learn how to use the piercing candle and the dark cloud cover as basing candles. So let's start with the piercing candle. The piercing candlestick pattern is obviously a bullish signal. It is also a moderately strong reversal signal. Like most of these candlestick patterns, the context in which this pattern occurs is very important. A true bullish piercing pattern occurs after a downtrend price. This pattern consists of a relatively large bearish candlestick, as you can see here, followed by a bullish candlestick that closes somewhere above the 50% mark of the preceding candlestick real body. When this pattern forms at the beginning of a strong move up, it can be used as a pacing candle to draw the demand zone. So to draw the demand zone using this pattern, you simply draw the proximal line at the close of the bullish candle and the distal line at the open of the bullish candle or at the lowest wick of both candles. Let me now show you some real chart examples. This is the Euro US dollar daily chart, and this is a drop, base, rally demand zone. These piercing candlestick patterns formed at the beginning of this strong move up. So to draw the demand zone, you draw the proximal line at the close of the bullish candle and the distal line at the lower shadow. When the market returned to test the demand zone, prices were strongly rejected, forming a doji candlestick pattern. Look at another example. This is the Euro JPY daily chart, and this is the drop, base, rally demand zone pattern. So this is a clear piercing pattern that was formed at the beginning of this move up. So to draw the demand zone, you draw the proximal line at the close of the bullish candle and the distal line at the lower shadow. Look at another example. This is the US dollar Canadian dollar daily chart. This is a drop, base and rally demand zone pattern. This is a piercing pattern, as you see. So to draw the demand zone, you can draw the proximal line at the close of the bullish candle and the distal line at this lower shadow. Now let's move to the bearish version of the piercing candlestick pattern, which is the dark cloud cover. Dark cloud cover is a bearish reversal pattern where a down candle opens above the close of the prior up candle and then closes below the midpoint of the up candle. When this pattern forms at the beginning of a strong move down, it can be used as a basing candle. When drawing supply zone using the dark cloud cover as a basing candle, you draw the proximal line at the close of the bearish candle and the distal line at the upper shadow. Let me give you some real chart examples. This is the Aussie US dollar daily chart, and this is a rally, base, drop supply zone. As you can see, this is a dark cloud cover candlestick pattern. To draw the supply zone, you draw the proximal line at the close of the bearish candle and the distal line at the upper shadow. As you can see, when the market returned to test the supply zone, it was rejected, forming a doji candlestick here and an engulfing bar pattern here. Let me show you another example. This is the British pound Swiss franc 1 hour chart, and this is a clear supply zone. As you can see, this is a dark cloud cover that was formed at the beginning of this supply zone. So to draw the supply zone, you draw the proximal line at the close of the bearish candle and the distal line at the upper shadow. Let me show you another example. This is the US dollar Canadian dollar daily chart, and this is a clear supply zone. The basing candle is this dark cloud cover. So to draw the zone, you draw the proximal line at the close of the bearish candle and the distal line at the upper shadow. As you can see, when the market returned to test the zone, prices were strongly rejected and the market moved strongly down. So that's what I can see about the piercing candlestick pattern and the dark cloud cover. See you in the next course.